In today's show, I want to discuss with you the 5 levels of investing, a framework that I have created to help you understand where you are on your journey, but more importantly, to make sure that you reach the top level as a successful property investor. Then I'm going to share some interesting information with you about the tsunami of wealth baby boomers are expected to leave their children. Some interesting chats today, and it's only going to be me and you, no guest today, as I share with you some ideas to help you become a more successful property investor. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
If you want to become a successful property investor, I believe you really need to understand the 5 levels of investing, which is a model I created to explain the progression most investors take in their path to developing financial freedom. Now, just to make things clear, this has nothing to do with your level of income. You see, I've seen many people who earn hundreds of thousands of dollars a year, spend most of it on flashy lifestyles, and they never actually achieve a substantial asset base. Having said that, I've also seen some very successful investors build a very substantial property investment business while working on what some would call menial day jobs, earning relatively little in their pay packet. In other words, their job becomes something they choose to do, not something they have to do for their primary source of income. So as I share these investor levels of wealth in my chat with you today, I'd like you to think about where you fit in your model, because most of us work our way up this level of investors, but interestingly, most never get to the top level. But if you understand where you are and what you've got to do, well, that's my hope in my chat with you today, you'll be able to work your way up to become a level 4 investor. Let's start with level 0 investors, and that's the spender. See, actually, level 0 aren't really investors. They tend to be spenders and borrowers, and as a result, they end up with a high level of debt. They spend everything they earn, and often more. Their money runs out before the month does. They usually survive from pay packet to pay packet, and they use credit cards and store cards if they can, where they need to. And if they have some money, they spend it. And if they don't have money, they borrow it. These are the people who, when they spend some cash, they go to the ATM and pay a fee to collect an advance on their own money, and then they even pay interest on that. So their solution to financial issues is that they spend their way out of it or take on more debt. Now, do you know any level 0 investors? Unfortunately, a large part of our adult population in Australia falls into this category, and they're never going to become wealthy unless they do something radically different about it. And that's the reason I'm explaining these levels of investor to you. Maybe somebody close to you, maybe somebody you know, your kids. Maybe you can help them by telling them about this. The next level is the level 1, the savers. The vast majority of Australians who are not spenders generally will be what I call savers. Their main investment's their home, which they aim to pay off over a period of time. Sometimes they save a little, squirreling a few dollars, what's left over after they're paying their tax. But in generally, if they save to consume, not to invest. Savers tend to be afraid of financial matters. They're generally unwilling to take risks. They're mostly following a plan their parents and their grandparents followed. Get a steady job, buy a house, pay it off, save a nest egg for retirement. The problem is saving, or even owning your own home outright, it doesn't make you rich. What usually happens is these people work hard over their lifetime, diligently save, and they pay off their home. And what they're left with is a modest, most likely an old, tired home. Savers are what I would call financially illiterate. They need to focus their efforts on building a solid base of financial and investment skills on which they can grow their financial future. they're going to get the most leverage by investing, firstly, in themselves, in their knowledge, and getting quality financial education. And then they've got to start building a network of peers that they can make the journey with. So that's level 1 investors, the savers. The level 2 investor is what I'd call the passive investor. They become aware of the need to invest. They realise their superannuation won't get them through retirement. So they start learning about investment. They begin accumulating some assets. And while they're generally intelligent people, they're still what I call financially illiterate. They don't really understand about the rules of money. But remember, it's not their fault. Nobody taught them. We're not taught this education in school, and we haven't learned it from our parents in general because most of our parents weren't wealthy either. So, if anything, their parents told them the old-fashioned, outdated concepts of money. So rather than taking responsibility for their financial education, level 2 investors tend to look for answers to their investment needs from outside sources or from so-called experts. Now, this makes them easy prey for the newest get-rich-quick schemes, for the flash-in-the-pan investment strategies spruiked by telemarketers. They're looking at Bitcoin, they're looking at the get-rich-quick property schemes, no money down or not using my own money, and they get caught out. Instead, they should refine their financial and investment education and focus their efforts on choosing a specific wealth vehicle that they're going to master. They first, of course, must unlearn their flawed, incorrect, misguided lessons that they've learned about money and wealth from unqualified teachers. So that's the level 2 investor. The level 3 investor is the active investor. They realise that they've got to take responsibility for their financial future and become actively involved in their investment decisions. They become financially literate by building a knowledge base of investment strategies and techniques. Now, they're starting to get their money working for them. That's the great thing about level 3 investors. And they actively participate in the management of their investments and concentrate on building their wealth. And their main focus is on growing their asset base. That's different to the average Australian who's just looking for more cash flow. And as this is the asset accumulation stage of their investment life, these investors generally have high growth, low yield investments to grow their wealth. In other words, residential real estate. That's where residential real estate really shines. It's the best asset class I know for growing your wealth safely. Now, level 3 investors usually leverage their time and expertise with a network of industry professionals as they realise that they can't do it all themselves. And they're the sort of clients we love working with at Metropole. So while I said they're actively involved, I'm not suggesting that they collect the rents or do up their properties. What I'm suggesting is they take a serious interest in their investment. And they have a network of advisors and peers and often join mastermind groups of like-minded people. But there's another level above that. And that's the level 4, the professional investor. But only a very small group of investors move to the top rung of the ladder and become level 4, what I call professional investors, who've now built and manage a true property investment business. Level 4 investors have a business with a substantial asset base that generates sufficient recurring passive income to pay for their lifestyle costs, plus keeps growing their investments whether they work in a real job or not. Now, that doesn't mean they give up their job, but they go to work because they have fun, because they want to do something, not because they have to. They're generally well-educated, they're generally financially fluent, they're comfortable with the language of money, and they understand how the game of money works. They understand the system of finance, tax and the law, and they use them to their advantage. They know the right questions to ask their advisors. They tend to concentrate on optimizing the performance of their properties while at the same time minimizing their risks. And while many of them are still at the accumulation asset stage, they're now more interested in cash flow that will allow them to gain the most out of their life. So you've got to go through the various stages to become financially independent. First of all, it's education. Then it's actually saving, spending less than you earn, and then investing and building an asset base. And then once you've got an asset base, you have choices, and only then can you move to the cash flow stage of your investment. You've often heard me say that most investors invest for cash flow because they don't have good money management skills, so they hope they're going to get money from their investments. But if you haven't got good money management skills, you shouldn't be taking on the debt to get involved in investment. These level 4 investors have a finance strategy and financial buffers to buy themselves time, and that helps see them through the ups and downs of the economic property cycles. Successful investors don't just buy properties, they buy time. They understand the laws as well as it relates to property, so they don't make the mistakes many beginning investors do. And these professional investors don't hand control of their investments over to others. They retain control while employing a proficient team of accountants, finance brokers, property managers, solicitors, property strategists who've got great systems to achieve repeated and consistent results, which are reliable and predictable. Now, of course, what this does is give level 4 investors the freedom to choose whether they get up in the morning to work or not. Now, I've found that most still continue to work because they enjoy it, but now they go to work because they choose to, not because they have to. Others find time to contribute more to the community or to charities. So what this means is neither the state of the economy or the stage of the property cycle affect these level 4 professional investors. They seem to make money in good times and bad. And the other interesting trend I see is level 4 investors rarely stop educating themselves. We see those people come to Wealth Retreat year after year. They're already financially successful, but they're still working on themselves. They still read. They still watch webinars, listen to podcasts, surround themselves with a team of advisors and mentors. And interestingly, they're prepared to pay for solid advice, not only to increase their wealth, but also to protect their assets from opportunistic family members, lawsuits, and the government. Now, interestingly, what this means is you'll find level 4 investors personally own very little in their own names. But even though they own nothing, they control everything through companies and trusts. By controlling the legal entities that own their assets, these investors gain considerable legal tax benefits and asset protection. And a final point about level 4 investors is they teach their financial knowledge to their children. They pass on their family fortune to future generations, as their companies and trusts often endure after they've departed this life. So again, I just want to make it clear that the asset growth stage occurs first, then the income stage. It's important to understand the stages you have to go through to become financially free. So educate yourself first, then you go through the asset accumulation stage. Your job as level 3 investor is to build a sufficiently large asset base to fuel your cash machine. Then, only when you've grown a substantial asset base do you transition to the cash flow, the income stage of your life as a level 4 investor. Sure, you need cash flow to service the debts as a level 3 investor, but your focus must be on asset growth rather than income growth. That's what's going to give you choices. So, what level are you at? I guess now it's time for some home truths. How far up the wealth pyramid are you? Where do you currently sit in this hierarchy of investors? Now, everyone starts at the bottom at level 0, but not everyone makes it to level 4. In fact, very few do. But you can, once you understand why the rich keep getting richer. Remember, this assessment of your current level of wealth has got nothing to do with your income, as I said a moment ago. You can be a low-income earner when it comes to your day job, but still be a level 3 investor. You still can end up with financial security. Likewise, you could be considered rich by working income standards, but still be a level 0 investor, spending every dollar you earn. So what I want you to understand is the pay packet that you work for every day has nothing to do with the level of wealth where you are, and it's in fact one of the worst predictors of wealth. So back to what I asked a moment ago. What level of investor are you? As I said, now it's time for some home truths. If you want to get to the next level, my suggestion is get somebody who's already a couple of levels above you to help you. And that's what my team at Metropole can do. We help beginning investors get into the property market. We help experienced investors get to the next level, and professional investors build their wealth faster through property development or buying commercial properties. But we have no properties for sale. So if you want to get up the rungs of the ladder, work your way up quicker without making the mistakes, part of what we do at Metropole is we fix problems. So if it's not working at the moment, we'll help you. We prevent problems and we improve your returns. And it all starts by giving you strategic property advice. allow us to build you a strategic property plan for you and your family, because planning is bringing your future into the present so you can do something about it now. So why not go to metropole.com.au and find out more about what we do. And then you may choose to use our buyer's agency, our wealth advisory, property management, financial planning, renovations, development, or business accelerator mastermind programs. We've got a range of services. I don't know what you need, but what I do know is that our advice is independent and it's proven. Interestingly, a recent, a couple of years ago now, audit of our clients showed that our clients were 7.3 times more likely to own 6 or more properties than the average property investor, because we have a framework to help grow our clients' wealth. Go to metropole.com.au, leave us your details. I'd love to be part of your ongoing wealth creation journey. Well, a moment ago I went through with you the various levels of investing, and now you're probably wondering, well, what do I do next? And what you do next will really depend upon what level of investor you are, because at each level you're going to have to learn different things. You're going to have different requirements, different leverage points to accelerate your investment success, as well as to minimize your risk. So let's start with some advice for beginners. If you're at level 0, level 1 or level 2, don't worry if you're at those levels. Everyone's got to start somewhere. So my advice is, if you're just starting, you should begin by investing in your financial education. It's important that you learn essential skills of investing, as well as becoming financially fluent, understanding the language of money, of finance and tax. And that happens by reading books, listening to this podcast, subscribing to my Property Update newsletter, reading other people's information as well. Now, you're really on the right track because you're part of my community, aren't you? Now's the right time to establish some sound financial habits if you're at the beginning of your investment journey, and get rid of your bad money habits and get rid of your bad debt, and continue to work more on yourself than you do on your job, so you can become more valuable to your employer, which will help you earn more, and it'll also help you as an investor. It's also a great time to find a mentor who's going to speed up your learning curve. It's a great time to join a mastermind group of like-minded people who are equally committed to achieving financial freedom through investment. And that's one of the reasons I set up my mentorship program that you can find out about at michaelyardney.com.au. And at this stage, at this early stage, don't be tempted to make substantial investment decisions, no matter how exciting, how enticing it may seem. You haven't yet developed the skills or the perspective to fully understand the risks involved, and unfortunately the landscape's littered with casualties of enthusiastic but amateurish investors who've lost it all before they really even began. I mean, the statistics show that 50% of people who get into property investment sell up in the first 5 years. Now, so many of these people weren't investors at all. Even though they thought they were, they're actually speculating with the hope that the value of what they bought would increase in the short term, even though they often didn't understand the fundamentals. So if you're at this beginning stage, it's also the time to build your professional network of contacts that you're going to later rely on and help you along your journey. Your mentor should also be able to help you have access to their address book. And that's what clients of Metropole have when we help build them a strategic property plan, because what it does is you've got access to our faculty of experts. Okay, so that's my advice for level 0, level 1 and level 2 investors. What if you're a level 3 and active investor? Well, then your focus should be on building your asset base and continuing to improve your financial skills. You'll have to choose which investment vehicle you want to use to grow your wealth. Now, in my mind, property is the best vehicle, but that doesn't mean that's the only vehicle. And in fact, if somebody says property only, or shares only, you should run away quickly, because when we build a strategic plan for clients, it involves property, the superannuation, and shares. In fact, it involves a lot more than that. A strategic plan involves an asset accumulation strategy. When we build a strategic property plan for our clients, we also add a manufacturing capital growth strategy, a rental growth strategy, an asset protection and tax minimisation strategy, a finance strategy including long-term debt reduction, and a living off your property portfolio strategy. What I'm suggesting is level 3 investors, you build a plan for your financial future so that you can get out of the rat race. So at level 3, you shouldn't be investing for cash flow. You should be investing for asset growth. You should be investing to build an asset base. Now, I'm not saying cash flow isn't important. It is important. It's essential to keep you in the game. But the only way you're going to get out of the rat race is by building a big enough asset base, and then that can become your cash machine. Next, I'm going to suggest you only invest when you can generate wealth-producing rates of return. And this is often through what I call forced appreciation. What I mean is when you buy an asset, whether it's property, a business, or any other asset, rather than just letting the marketplace do the heavy lifting, especially at this time of the cycle when growth won't be as stupendous as it was a year or two ago, you should be able to add significant value through the work you add to it after buying. And a great example of that is when you buy a property and you add value through renovations, thereby manufacturing capital growth, as well as increasing the rental returns and the depreciation allowance. That's a great example of what I call forced appreciation, as the increase in value had little to do with what's going on in the market and a lot more to do with how you forced the property to become more valuable by the skills you brought to the deal and improvements that you made. Much the same can happen if you buy a business and add value. However, it's virtually impossible to force appreciation when you buy stocks in a publicly listed company. So this concept of forced appreciation is important to level 3 investors because it speeds up your wealth creation journey, and it's extremely tax effective because in general, the gains in value won't be taxed. So to use the power of forced appreciation early in your journey, you'll have to put in the time and energy to educate yourself, or better still, harness the power of a good team of experts who've already achieved the sort of results that you're wanting to. While I'm suggesting beginning investors display caution, as you become a successful level 3 investor and aggressively grow your asset base, it could be time to start taking some calculated risks and magnify your return by using even more leverage. At this stage, it's critical, of course, to get sound tax advice and grow your asset base in a tax-advantaged strategy. That's one of the things Ken Race and his team at Metropole Wealth Advisory specialise in, because all the successful investors I know own their assets in structures, not in their own name. It's also a good time to get legal advice regarding asset protection and estate planning, especially if you're looking to set up a lifetime legacy for your children and grandchildren. What I'm hoping that you do is build life-changing wealth and intergenerational wealth. And then as you progress up the rungs of the investment ladder as an advanced level 3 investor, you're going to start transitioning from the asset growth stage to the passive income stage of your investment journey. And the skills and strategies you use to become level 3 won't necessarily make you a professional level 4 investor. This means you're going to have to keep working on yourself as much as you do on your investment business. Can you see a theme here? Successful investors never stop learning. So to finish off my chat with you today, let's look at why more investors aren't successful. Because you're probably thinking, well, if it is as easy, if there are these rungs you've got to work up, why don't most achieve it? And in my experience, there are generally 4 main reasons why investors fail to become successful. Well, most don't even start investing because most Australians are just too busy leading their lives. They're not even thinking about investing. And many who do invest start too late for compounding to work its magic. It actually takes time to become financially independent. It's not a get-rich-quick scheme. For most investors, it takes up to 30 years to become financially independent. Now, part of that is because for the first 10 years, they learn, well, they do the wrong things. They've got to learn what not to do. But to do that, you often have to make mistakes. I'd rather you avoid that first 10 years by getting the right mentors or getting Metropole to help you by putting a strategic plan together. And then it takes a number of property cycles to develop financial independence by building a big enough asset base. And some investors just pay too much in fees or tax along the way, which erodes the returns and therefore their eventual financial success. And I guess the other thing is many investors just make poor investment decisions. They follow the herd. They invest near the end of the boom because they're being carried away by the optimism of the media And what makes it worse is they sell up when the market sentiment changes and pessimism prevails. And they get into the property market, the stock market, trying to time the market. It doesn't work that way. So I guess a lot of this has to do with one thing, what I call financial illiteracy. Since you weren't taught about investing at school, it's unlikely you've had wealthy mentors. And that's why I keep saying it's important to get a right team of people around you, people who understand wealth, understand how the game of tax finance money works, and who are independent and are not there to sell you but give you strategic advice. So there you go. Life's too important to simply work for your money. You should be enjoying your life by having your money work for you. So you need to transition over the years from working for your money and having your money work for you. So no matter what level of investor you are today, whether you're a beginner or a seasoned professional, I believe that you can continue growing up the ladder in investing. While it can be intimidating, and there are big numbers and concepts and money and emotion and salespeople in your future all involved, the journey to financial freedom can be a long one, and you won't arrive at the final destination any sooner by rushing or looking at get-rich-quick schemes or cutting corners. So understand where you are on this wealth ladder and work your way up. But again, work your way up by educating yourself and getting a good team around you. It's been a long chat today about this big picture concept, but I hope you can understand why I did that. Because while I normally talk about where to buy in property or what's happening in the economy, it's important to understand a bit about you and why I'd like you to use the right frameworks to climb up the rungs of financial freedom. I'd like to have a bit of a chat with you about a future wealth tsunami that's going to occur as baby boomers leave their wealth to their children. You see, Australians are getting richer, with the average per capita income wealth rising to a record high, despite the challenges of our economy and despite the pandemic. And of course, much of this wealth growth can be attributed to our baby boomers, who are reaping the rewards of a booming property market and the long-term investments that they've had in their homes, in their investment properties, and in their superannuation. In fact, baby boomers are our wealthiest generation, and there are plenty of them. I'm one, and it's been called the baby boom for good reason. Around 21% of our population is over 60, up from about 15% in 1986. And this generation, the baby boomers, is set to transfer a staggering $3.5 trillion worth of wealth to their children. That's a massive tsunami of cash currently locked in real estate and super. But where's this tsunami of cash going to go? Well, when the baby boomers pass on, and that's going to be a while yet, this money is going to be bequeathed to the next generation and will be then injected into the Australian economy over the next few decades. There are alternatives to this, of course. Research by McCrindle Research revealed that the average Australian would be around $320,000 better off if they received their inheritance from the baby boomers, their parents, today. Now, while it seems that many Australians will inherit quite a windfall when their parents pass away, just how much of this wealth will actually be passed down, I guess that remains to be seen. And there are a few things to be considered. Firstly, Australians are living longer, with the average 65-year-old today expected to live 7 years longer than their parents did. Now, that's good news for me, being a baby boomer. Now, not only are we living longer, we're staying healthier in old age too, which means we're going to continue to be active, we're going to have expensive hobbies, we're going to holiday more. I'm enjoying cruises and I'm enjoying spending my kids' inheritance now for many years to come. Our holidays, for most baby boomers, are becoming more lavish, more expensive, especially with the international borders going to be reopening again, or they are already open, but we're not travelling much overseas just yet. But we're planning to, personally. After 2 years of the border closures and travel bans, I know that cashed-up retirees, who are amongst the first to become fully vaccinated, they're bound to be hitting the tarmac to make up for lost time. So it's possible that much of this pent-up wealth is going to be splashed on cruises and luxury caravans as baby boomers seek to enjoy their retirement in style. It's a very different situation to how the baby boomers' parents, our parents, lived, that's for sure. So how did we get here when in previous generations children were almost always wealthier than their parents? That's an interesting change. You see, in fact, the current crop of baby boomers is vastly different to the generations that have come before them. Many have come from working class backgrounds and they've climbed up the economic ladders through, well, we had free tertiary education. That's a perk that today's graduates with their hefty HECS debts just haven't got. In fact, the average university leaver in 2016 is saddled with a whopping $28,333 in education debt. More for those who've studied courses such as medicine or law or engineering. And that compares with no debt that was incurred by somebody who finished their degree in 1986, for example. Baby boomers began earning a living at a younger age than their children, and they were able to buy property before prices kept rising significantly. In 1975, if you think back, the average home in Sydney cost 5 times the average full-time income, but more recently it's soared to 13, 14 times the average income. Now, sure, interest rates are much, much cheaper now than they were then. And baby boomers have actually gone out to out-earn their parents, and they expect a much higher standard of living than they had when they were growing up. So what's ahead? Well, now it seems that the Gen Xers and millennials will be the recipients of this unprecedented accumulation of wealth. But if baby boomer parents do indeed leave their stockpile of cash to the next generation, how would they spend it? Well, according to research done by McCrindle researchers, most would stash it away in savings. Now, is that the right move? If you genuinely want to become rich, not just financially comfortable, but properly wealthy? Well, with interest rates on savings accounts dismally low, it's clear that banking and inheritance would be a huge missed opportunity. Modelling from McCrindle researchers showed that a $326,000 inheritance invested in property with an annual growth rate of, let's say, 7.25% would see Gen Xers more than $2 million better off by the time they reach retirement age. That $2 million is in addition to that real estate they already own, their super and other savings. Imagine the retirement they could have with that. So it'll certainly be interesting to see how much of this wealth is indeed passed on, what the baby boomers are going to do, and what those who are lucky enough to receive it will do with it. I guess we're just going to have to wait to find out. But it was interesting to read this research and see that there are going to be good times ahead for the next generations. Just another reason I'm confident about the long-term future of Australia and Australian real estate. I hope you got some benefit from my chat with you today, and I've got an extra bonus for you, or actually a group of bonuses, as my way of saying thank you for subscribing to this podcast. If you go to podcastbonus.com.au, I've got a range of ebooks and reports for you. I'll leave a link in the show notes, podcastbonus.com.au. And if you did get some benefit from today's show, and you know somebody else who'd benefit from learning about the levels of investor, please tell them about the Michael Yardney podcast. You'd be doing me a real favour, but you'd also be doing them a favour, because my aim is to make as many Australians as financially fluent as possible. Now, I'm really proud of how many people are listening to the show. We've had over 3 million downloads, but I still want to get to more people, so help me in my quest. Now, you can catch me in between these shows on social media. Just look for Michael Yardney, or join my private Facebook group. Go to Facebook and look for the Property Update private Facebook group, where each day I leave some tips, some charts, just something a bit interesting you won't find elsewhere. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?